when you are looking to invest, right, even in mutual funds, you have equity, you have debt, you have hybrid, right? How should they sort of decide how to allocate their funds?
So basically, you correctly mentioned the three type categories of funds. Debt funds are largely uh, uh, basically competing against the savings accounts and the fixed deposits. Earlier, there was a tax advantage to them. Now there is no tax advantage. So what are the benefits of debt funds? Is that generally they tend to beat the savings account and the fixed deposits because of two reasons. One is that when you're fixed deposit, the bank fixes the rate. How does he fix the rate? He decides at what rate he can lend in the market, takes off his cost of his office, salaries, falana, falana, or if a loan goes bad or whatever, deducts that, deducts his profit margin, what he feels he should deserves, and then sets the deposit rate to you.
Right.
What the mutual fund does is take your money and directly give it to that end lender. So entire cost of the bank, its salaries, its rented building, all that goes away. So that savings of that cost is shared between the profit that the fund managers make and that return that you get. So generally, debt mutual funds give you a slightly better return than fixed deposit. Second aspect is that there is also the taxation element. Now you put money in a savings account and a fixed deposit. What happens is that the bank gives you interest every quarter. And in a fixed deposit, you can say, I don't want the interest today. I'll take it at the end of the fixed deposit, right? You can let it compound. But even if you do that, you have to pay tax on the accrued interest. Though you didn't get it in cash from the bank, you have to pay tax. So every year, the bank gives a statement to the income tax authorities through something called AIS, where they say, this person with this PAN number, I paid him so much interest. If it's above a certain level, he deducts TDS from it. Even otherwise, it gets counted. You'll have to pay your 30% tax on that. But in a mutual fund, compounding inside takes place and you only pay the tax on it when you take out the money. So for 10 years, if you have not taken the money, you don't pay any tax for 10 years. And the 10th year, depending on what profit you make, that year you make. So you save that interest on the tax, right? Because you keep paying the tax, you lost the money, right? Debt mutual funds are generally then safer as a category. They are meant to take care of your short-term needs for money. They are not an ideal inflation-beating wealth creation vehicle. They are
Okay.
meant to cater to your need to park your money for a short time. You know that in a year, year and a half, I'll need the money, 2 years. They are ideally positioned for that.